All right, part two of this week's lecture, we're going to jump in and begin to look now at withholding allowances, how much to take out of the employee's paycheck to put into their federal income tax withholding. So what every employee has to do, or they should do, they don't, I guess, have to do it, but they should, is they need to fill out this W-4 form. You usually can just fill it out once and it'll be fine for the rest of the time, unless something changes. If something changes, then you need to go back and update your W-4. You can update your W-4 at any point. You don't, anytime you have a major life event happen, meaning you got married or divorced, would be a major life event that's going to affect this, or you had a kid, or you have an extra dependent that you didn't in the past. Those would be some major life events that you would definitely want to go back and change your W-4. The only other thing I can that you would want to change your W-4 is if you are married and your spouse got either a new position with a much different pay, higher or lower, or your spouse stopped working altogether or started working. The only other thing would be is if you or anybody in your you or your spouse started their own business and had extra money coming in from the side that way, then you would possibly want to update your W-4 to have more taxes taken out. Okay, so there has been a major overhaul. If you filled out a W-4 prior to 2020, then the form would have looked quite a bit different. It was a little smaller, and I think it was a little easier to figure up. I think the W-4 overhaul has made it a little bit not nearly as easy to calculate if you don't really know what you're doing and where to look up the numbers. And most people, they don't need to because their employers are going to do it. But I still think it'd be nice if it was a little bit easier to break down. What we're going to do is we're going to go through the W-4. So if you don't have it, go ahead and open that up now. Go ahead and pause the video. And let's follow along with this W-4. So go ahead and pause. All right, so the W-4, you might think, oh, well, it looks kind of the same to me. Well, that's if you haven't looked at very many W-4s, maybe only one or two times, then okay, you might think it looks similar, but it's really quite a bit different. The first thing, if you are familiar with a prior one, it asked you how many allowances did you want to take, and that was similar to exemptions. Well, on the 1040, they don't have exemptions anymore, and so on the W-4, they don't have allowances anymore. So that was a big change. You still are going to indicate what your filing status is, because that will make a difference on the amount of taxes that are taken out. Then in step 2, they're going to ask you, the main thing about step 2 here is, do you have an extra job, or does your spouse also work? And how is that spouse's income compared to yours? If the spouse's income is very close, so there's two jobs and both spouses make about the same money, doesn't need to be the same, maybe within $5,000 would be similar pay, then you could check this box and we'll see what that means. You're going to use the other side basically of the calculations. So remember this box here that's checked if both spouses make the same. Then we're going to come down to step 3, and this is if you have kids or any other dependents at home. You're going to put in the amount here. You're going to multiply. So if you have 2 kids under the age of 17, you would put in 4,000 here, 2,000 times 2. And this is going to really cut down on the amount of taxes that you pay because of what's called the child tax credit on your 1040. Any other dependents, like if you take care of your parents who are elderly and they are considered your dependents now, then you get $500 a piece for each dependent that's not a qualifying kid. And then finally down here in step 4 is where we calculate if we have any extra income coming from other jobs that we have, like a side business, we would want to factor that in here. And then this part here is going to go based on if your spouse has a separate job than you and they're not similarly paid, then you wouldn't check box 2 up there. You're going to have to come down here to page 4 and then find the amount. And we're going to see all this. We're going to do some examples. But this is saying, okay, look at the higher. Doesn't necessarily mean it's your position or your spouse's. It just says the higher paying job, use this column. The lower paying job, use this, and then find where they meet. And that's the amount that we would put into our calculations. So make sure you always check here what the filing status is, because that will make a difference. Okay, so now once we have that, the other thing that you have to have pulled up to do federal income tax is publication 15. 15T. Let's go down here. We get the right word. Yeah, 15T. Make sure I said that right. I'm going to go. Oh, I already have that pulled up. So if you don't, go ahead and pause and pull up publication 15T. It will look like this on your front page. If mine catches up, still think it's thinking. I may just have to reopen it. All right, so this is what it looks like. This is what you would use this whole, you can see there's a lot of pages, all the different ways that you can figure out how much taxes to take out. So this, you need to pay close attention to the dates. So this one actually includes 2 different years because they have switched. They've changed the way it's been done, because remember the W-4s changed, so therefore they had to do these guys a little different too. So anything 2019 and before, you're going to use certain tables. 2020, which is what we're doing, and later we're using other ones. We're going to jump down and we're doing this one. We're doing the percentage method for each form from let me see here we go. This one, sorry, number 4, page 51. We're doing the percentage method for 2020 and later. Some of the items you can fill out this whole entire thing here, but the way basically that we're going to be solving them is in a way filling this out. But this, I think these kind of seem kind of confusing. If you try to read it and understand it, you'd be like, I don't know what's going on. Hopefully my way will be a little bit easier for you. And then we're going to look here. We're going to come down to the next page, page 52. We always want to check this item first. Which pay, what type of pay are the employees getting? Weekly, bi-weekly, semi-monthly, or monthly are the 4 primary ones that we're going to be using. And then this, remember I said you're going to, depending on how you, if you check the box in that part 2, this is if you did not check the box, you use this one. If you did check the box, so you and your spouse made about the same amount of money. If you had a spouse, if you did have a spouse and you didn't make the same amount of money, or even if you don't have a spouse, you're going to use this site. All right, I know that sounds confusing so far. Let's start looking at some actual examples to break it down. All right, so here we are calculating the federal income tax, starting there on page 52, which was actually 51 on the little link, but then we come down to page 52. If you are looking for this online and you are in a future semesters in the 2021, make sure you actually look for the 2020, or just use the link that's in the class session there, because that is the one that we will be using, the 2020. 2021 will be slightly different. Just because of inflation, the numbers will change a little bit. I kind of went through here and explained what we're going to be doing. I'm not going to go through and read that right now. You can come back to that and see how that makes sense. But we're going to actually just start, and I'm going to be talking us through a couple of these examples. And then I think the parts above will make a little bit more sense. Okay, part 1, practice example. We got an individual. This is key, how often they're paid. They're single, that's going to be key. We need to know that. Their filing status. They have one job, that's important. They don't. And then this is how much they have for federal taxable withholding. This is their taxable income. And then when if you would get your calculator out, I just put this out here to the side just so you can kind of get an idea of what that means in annual salary. If they make $3,000 taxable and they're paid bi-weekly, so that means every other week, they're paid, that would equal out to be 26 pays. So 3,000 times 26 is 78. That's where I came up with that. All right, now let's look at how we actually calculate this amount. Nothing odd is going on here. So what I mean by odd is if we go back up to these words that I had here, step 2, we're single or married with only one job. Well, we can skip part 2. So I can just skip the rest of this. Go down to part 3. Use instead of allowances. Doesn't say anything on us about having any kids or any extra dependents. So we don't have to do step 3. Doesn't say anything about needing extra money withheld. So we don't need to do step 4 then either. We can go right to the figuring up the amount of tax to be withheld. All right, so let's get our facts again. Bi-weekly. So I want to use the next form down. This is the weekly form. Bi-weekly. We are single. So I want to come over here. And I'm looking at the left side because box 2 is not checked. I don't have extra money coming out from a separate job. I don't have a spouse, so definitely it's not checked. Then what we do is we come back here and we look at, all right, what's your taxable federal taxable income? That's why we need to know not just gross. This isn't gross income. This is after those certain deductions that we got to take, like taking out for medical insurance premium. It says it's 3,000. So we find where 3,000 falls. So it falls here. Then we want to go way over to the right side. And then we can start doing the calculation. You take 3,000. And then you subtract the first number that we come to off on the far right. That's basically the amount that we're over this threshold. And that puts us into the 22nd percent bracket. So it's saying whatever you made over that threshold, every dollar that you made over 2,020 bucks is taxed at 22%. All of the money you made before 2020 dollars is taxed either at 12, 10, or 0%, depending on where the first 477 is taxed at nothing. So then what it says, once you figured up those dollars at 22%, so you subtract out the 2020, multiply that by the rate, and then add in whatever they tell you is left. So 215 plus 177 comes out to be 393. That's how much taxes should be taken out of this individual's paycheck every other week, bi-weekly. And if you multiply that out, he makes 78 grand. He would have annual taxes taken out of his paycheck of 10,300. Now the question would come, okay, sure, you gave me this number. We figured it up as 393. Does that really work in a real life situation? So I actually did that. Now the only difference is this is using 2020 numbers. Tax software hasn't came out for 2020 as of this recording in November of 2020. So I still have to use the 2019 software. The 2019 software is going to be slightly different just because of inflation purposes, but I wanted to show you how close it really does work out. So I put in this individual. I have an individual, let's go, and I already put in their stuff real easy. I just put in Joe Lecture. So lecture example number 1, he's single. And I put in that he made 78,000, which is what we had. And I put in that when I went to his W-2, I put in that he had 10,300 when you multiply that out. taken out of his paycheck. 10,000 right here, 10,300 taken out of his paycheck, federal withheld. When the calculation was done through the tax software, it's saying he actually owed for the year 10,340. So you can see it got us real close. If this would have been 2020 software, it would have probably made him almost identically even, maybe slightly owed $1, $5 either on side, maybe up to $100 a refund perhaps. But we only owe 40 bucks. So when you're talking owing out of 10,000 that you paid and you only end up owing 40, that's pretty small. So this number checked out, that's taken out. Now, if he doesn't want to owe the next year, then he can tell his company, he can amend the W-4 and say, take out an extra $10 every paycheck. So make it 403. And then I shouldn't owe any and I'll get a small refund. Okay, now let's look at our next example. This one adds a new item. This one adds if we have some kids. So this individual is paid semi-monthly. We are filing as head of household. So not married, but we have kids that are living with us. $2,100 is taxable for federal withholding. If you break that down over a whole year, this person is paid $50,400 in a year. This person also shows that they're having 4,000. They have 2 kids at home that they are claiming. So that would be part 3, the 2,000 times 2. So 4,000. All right, so how we solve this one? We don't have a spouse. We don't have any other job, so we can skip past that step 2. That means we can go ahead and start calculating, and then we'll come back to part 3 because we definitely have to come back to that one. So the first thing that I'm going to do is start calculating from my table. So let's get our facts again. Semi-monthly, and I'm looking at head of household. Okay, so semi-monthly, that would be the next chart down. So this is what I'm looking for. Now remember, you can't just choose whatever side. You have to pick the right one. You can't just start going over here. This one is checked, box 2, and it is not on our example because we don't have a second job or we don't have a spouse with a similar paying second job. So we're using this one over here. Okay, our amount that we had federal tax is $2,100. We are head of household, so I'm going to want to come down to head of household. $2,100 is going to fall here. So what we're going to do is come out to the far right. We're going to take 2,100, subtract out the 1,365. That's the amount over this threshold, and we're going to multiply that amount. All of those dollars are taxed at 12%. The remaining, what we're going to do with that amount, we're going to take the 8820 and then add in 5880. That's what it tells us to do here. Now, this is how much I would have taken out of my check per pay if I didn't have any kids. But I have 2 kids. I can tell that just by looking at this amount on my part 3 of the W-4, because remember part 3 right here. We had 4,000 total taken out for box 3 here. I mean, there's a chance I have 6 dependents. Probably, actually it'd be 8 dependents. Probably unlikely. It's probably more likely that I have 2 kids under the age of 17, and that's where that came from. What we need to do at this point is we need to take that amount in box 3, divide it by the number of pays we have. So I want 4,000, and I want to divide that by, if we're paid semi-monthly, we got to think, okay, how many pays is that? Semi-monthly is twice a month. There's 12 pays, there's 12 months, so 12 times 2 is 24. Whatever I come up with, that's what I'm going to subtract from the amount that I would originally paid in. And that's whatever's left is what I would owe. And since this would be a negative amount, this says I don't owe anything. I don't need to have anything taken out of my paycheck. I can have stuff taken out. I can put on there that I want an extra 10 bucks taken out just so my refund will be a little higher if I choose to do that. But this is saying if you don't have any money taken out, you'll still be okay when you file your taxes. And well, again, I wanted to prove that. Let's check it out and see if that comes true. So I'm going to pull up my other example I already did. And I call this Joe Practice lecture example number 2. Go into our 1040. Here I've got my guy here. He's filing head of household. We've got kid 1, kid 2. I go down and I put in his salary, $50,400. Nothing was actually taken out of my paycheck. So when I come up here, federal income taxes withheld, 0. Notice here, my final refund, I still get a refund, even though I took nothing out. I'm still getting back $428. So that it kind of proved itself that I didn't need to have anything taken out of my paychecks, and I still wouldn't owe at the end of the year. All right. My last example. This person, this time we have a spouse. And the spouse, we make, and we would want to calculate this out. We would want to see, is ours up close to my spouse? We're paid weekly. Weekly pay, the spouse earns $27,000 a year. We're paid weekly 1150 taxable. If I multiply that by 52 weeks, I don't make a similar amount to the spouse. So what we're going to have to do is we're going to need to, I'll show you, we're going to need to use the charts at the bottom of W4. Let me take a step back and just show you, if this would have said this person made 55,000 or even as high as 65,000, then what we would have done in that case, we would have looked at the W4 and check marked this box here because the spouse and the taxpayer paid the same amount or earned the same amount. Then we would have come here and it is checked, and we would have used this side at that point to figure our calculations with both spouses making about the same. And then therefore, what this side is going to do is it's going to tell you need to take out more money. Because if you make 60,000, you're going to be taxed lower if it was just you making that 60,000 compared to you and your spouse, because now together, when you do your taxes at the end of the year, you've made 120,000. So therefore, all of the income is taxed a little bit higher. So you need to use this side, and it's going to tax you a little bit higher over here, so you don't end up owing at the end of the year. Now, that's not the case. We're still not checking box 2 for our example because our spouse did not make the same amount or nearly the same. So how we do this one, still start out the same. We still want to go ahead and calculate based on the chart. So we're going to look up married filing joint, paid weekly, 1150. So this is semi-monthly. I got to go back up to page 52. All right, weekly. We are married filing joint. Box 2 is not checked. I want to go down to 1150, which would be in this line item here, in this row. Come over. So I'm going to take 1150 minus the 857. And then whatever that difference is, all of that money is taxed at 12%. The rest is taxed lower. So take that $35 and then add it in to another 38. Okay, so now I've taken care of the first part, figuring out how much tax I should have taken out bare bones. Now I can come here, let's do this part next. This part says, oh, we got kids at home, plus looks like an extra dependent. Maybe it's a 20-year-old kid that still lives at home, I still take care of, not in school. So I get to take $500 for that child, if that was the case. Or maybe it's a parent that lives at home, who knows, could be anything. So I'm gonna take $4,500 and divide that by the number of weeks. So that's $86 I take off of this. So right now, I'm in the negative if I'd be doing this right now. But I'm gonna, before I do that, I'm gonna do my final step. I'm gonna do the part for my spouse. And that, we go back to the 1040. And that's where we come down here and use this chart. For the higher paying job and then the lower paying job. So the higher paying job, when we calculated this out, it was $59.80. So I just am at this threshold here. And then I go to my spouse. My spouse made 27. So I'm going to come over here to between 20 and 29. And it says 3,050. I'm going to take 3,050 and do the same thing that I did in part 3. I'm going to take that and divide it by 52 weeks. And this I'm going to add to this number. So I take my base number, subtract out this guy, add in the extra that I need to take out because my spouse is now making money and we're going to be in a higher tax bracket. When I add up all of the amounts, what should be taken out is $45.27. So that one, I know you might want to go through that one a couple more times. Or I actually have some practice examples that I would highly encourage you to try before you do the homework. And I have the answers so you can check your work. Okay, let's finish out. We don't got much left to do now. So when you're filling out, this is all on the W-4, get some of this information, then you have to go to that publication 15T to do the calculations. For retirement distributions, since you're not taxed right away, you are taxed later on. The retirement distributions, they still have it set up like this as married with 3 allowances. I checked, even though the 3 allowances are not necessarily there anymore. You're going to file what's known as a W-4P. So the retirement company isn't going to take out, a lot of times they don't take out quite enough money because there's quite a few people who are retired who are either widowed or single. Maybe they don't have any other people living with them. And so if it takes it out as though married, they're taking out too much. So you would want to go to your retirement company and request a W-4P and then fill it out, and then they'll take out taxes a little more accurately so you don't end up owing at the end of the year. What I wanted the final thing to do here is we were looking at percentages when we were doing the 15T, when I said multiply by the percentage, whatever you're over. This is what's known as your marginal rate. So as you can see, there are basically 7 marginal rates if you don't count the 0. These are actually some of the lowest rates they've been in a very long time. Back in the 40s and 50s, this number was as high as about 90%. And so what that basically just made, the rich figured out ways to put money overseas, to find other loopholes. Yeah, where they really bringing in extra money, probably not that much extra, because nobody's going to want to pay 90%, even if you are extremely wealthy. If you make $1 million, you're not going to want to pay 900,000 of that into tax. That just is a little ridiculous. And so they're back down to maybe a little bit more extreme. Before the Trump tax overhaul in 2017, 2018, this was up to 39.6. So it's come down a little bit, not a lot. These are your marginal rates. And that's the first thing that I want us to know is what is a marginal rate. That's basically if you make $1 more or your spouse makes $1 more, all of that income is going to be taxed at that next rate. So it's going to be taxed at a higher percentage. And there's a big difference between once you go from 12 to 22. There's quite a bit more taxes that start coming out. So not as much if you just go from 10 to 12, a little bit difference, but big difference in these two when you go from the lower income to the mid income levels. And then the other terminology is the average tax rate. Your average tax rate is where you simply take how much tax do you owe in total and then divide that by your taxable income. So what are you owing in tax and divide it by your taxable income? And then that's going to give you an average percent. So just because your marginal rate is 12, well, that's only what you're paying on for wages above $857. Your average rate is going to be a little bit lower because some of all the other money was either taxed at 10% or at 0. So when we do some of the examples, you're going to find that the average rate is always going to be lower unless you're in the very lowest bracket anyway. If you're in the very low bracket, then it'll be the same. But otherwise, it's going to be lower. And I ask us here then, okay, let's go back. What is the marginal and the average rate for the 3 examples we just did? Okay, so let's go back up here. Part 1, the marginal rate was the 22%. The average rate, we can do it one of 2 ways. We can just take the 393 and divide it by what's taxable for that pay, 3,000. So even though we were in the 22nd marginal bracket, our average rate was quite a bit lower. We really only paid 13% on every single dollar if we did it the same. The other way you could have done it is simply taken this 10,300 and divided it by your total pay for the year. You're going to get the same amount. So what I want you to do is do the next 2 and let's see what you get, and then we'll show the answers for you to check. So go ahead and pause now. All right, here are your answers. We were at the 12% actual marginal rate, but they don't pay anything in tax, so their average rate is 0. And then 22, and it was quite a bit lower because we had kids, and that took our tax rate way back down. We added a little bit extra back in for our spouse, so we really only paid right at about 8%. All right. What I want you to do in this example is we're going to determine the federal withholdings, marginal rate, and the average rate. So I want you to read through this, determine what is the taxable income, and then use that to figure out what your federal withholding rate is. Go ahead and pause now. All right, so we're going to take 3,000, but that's our gross salary. We need to take out the items that are not taxable. We can take out 150 in medical premiums. We have to leave this in there, the charity. We can take out 200 in 401k. That's also okay. So we're left with 2,700. Sorry, 2,650. This was 150, not 100. 2,650 as taxable. That's the amount that I'm going to use when I go into my publication 15T. I see that the individual is single and I need to go to semi-monthly. And then I'll use the chart side on the left because box 2 would not be checked. When you work that out, hopefully what you got was this. But then we have one other piece of information. It says she has 2,000 on step 3. So we need to take 2,000 and divide it by the number of pays. The number of pays would be 24. So take 2,000 divided by 24. We're going to subtract out $83 from our base amount. So what she's going to have taken out of her paycheck, $210.51. With that, our marginal rate, we were in that 22nd% bracket. Then when we take 210.51 and divide it by our taxable income, so not by 3,000, but by 2650, 7.94 average, which is quite a bit lower than the marginal rate. The only thing different that Lecture 5 does is you're just going to go through and do the entire payroll register. So you're going to be taking out your template. And so you should read through this, and you don't need to do this down here. You can just do it on your template. So perhaps this is just for you to, I want you to be able to determine and tell me what your FICA taxable and your federal withholding pays. And then this is just showing you that, yeah, go ahead and do your template. And you don't need to do the state or county. I didn't put those in there. And then do the employer expenses, and then finish it out by doing paying off the taxes 15 days later. All right, so go ahead and pause now and fill that out, and let's see how you do. All right, so after you take your you earn $1,450, that's your gross pay. And then says she has $150 taken out for medical premiums. Yep, that's good for both federal and for FICA purposes. $100 for dependent flexible care, that's fine for both. $100 for 401k, that's only good for the federal. So when you are looking at your Excel sheet, I know I don't have the Excel sheet pulled up, but this is what you would have for your FICA taxable pay. So for Social Security and for Medicare. This is what you would have for your federal withholdings. You're not federal withholding, your federal income tax, federal income taxable wages. Then your payroll template should calculate out the Social Security at this point and the Medicare. I tell us down here that this is the third pay of the year, so we've only had 2 prior pays. So therefore we won't have definitely met the Social Security cap, and I'm not having us worry about the feud and SUTA at this point yet. So federal withholdings, how we got that, we take the 110, our starting amount, and then we go into the chart where we are paid biweekly, single, and when you fill that out, the bare bones number you get is 6716, and then it says she has 2,500 in step 3. If I take 2,500, divide that over the 26 pays for biweekly, so she has no money taken out for federal purposes unless she has requested some. So this is what your just the bare bones of the payroll register would have looked like. We would have had this Social Security, Medicare, federal, and then you would have had a net pay if you didn't show any state, or if you took out the state, if you took out the county, because I didn't mention those. This is how much she would have been paid. Remember, you start back with your gross. Then when it's our journal entry piece, we would have normally had FUTA and SUTA here. So maybe I'm going to put that in here. I'm going to put for now, let's ignore FUTA and SUTA for this pay until we get to that section in our progression of the class. So that's what her payroll tax expense when we ignore FUTA and SUTA. And then it tells us in the problem that the employer paid $200 in medical premiums. So that's an extra expense. It says the employer matched her 401k expense. So they put in an extra 100. And then finally, when it came time to pay the Social Security, federal, and Medicare taxes, well, we didn't have any federal, it was 0. Social Security, though, was doubled. 74 and 74 comes out to the 148. Medicare, the same, we had 2 of them. And then we would have had a check payment of 183. All right, that wraps up everything here for week 4. I'll see you back here for week 5.